Good afternoon, everyone. Welcome to Cycle Theory today. And we have Chief Market Strategist AJ Monty with us, who's going to be going through to explain and enlighten us a little bit more about cycle theory and why that is important and why we should pay attention to it. With that, AJ, I want to pass it over to you.
Thank you very much, Chris, and welcome everyone to today's presentation, especially those who are joining us for the very first time. This is always a favorite topic of mine because it seems as though we generally present it either at the end of a year or the beginning of a new year, and here we are, in the last days of the first month of the new year, so the timing is perfect. And actually, if you look at this slide, you might think, oh, this is just a bunch of legal jargon. My reason for showing this to you is because there's a term in here. I don't know if you could see this, risk tolerance. It says right there, risk tolerance and liquidity needs. When I'm looking at a chart, when I'm talking to traders and investors, I'm actually using the chart as a risk management tool. So no matter what your risk tolerance is, it's important that when we do look at the charts and you understand how everything works in cycles, not just the financial markets, but our world, our weather. I'll describe this to you. Everything is in cycles. If you're trying to hold on to a particular investment or a trade and the cycle starts moving against you, then you better really do something to protect your downside, because if you don't protect your downside, then you're opening yourself up to unnecessary risk. So this, of course, is the introduction to cycle theory. If you've been through this before, maybe sometime last year, it's always a good thing to more or less review this, because I tell people all the time, repetition is the best teacher. And I'm learning this. Here I am in the markets for almost 40 years, and it's kind of funny. But for me, as I get older, I don't want to rely on my memory as much, so I tend to repeat things over and over and over. And of course, my wife always repeats things to me because she tells me I don't listen to her. But with that said, cycles are very, very important, and I want to make this presentation as exciting for you and as practical for you as possible. Obviously, this is a picture of the seasons, where we have, the winter, the summer, the fall, and the spring. And I love living in Florida because I live far enough north where I won't get the snow like you see all the way to the right here. But we do actually get cold and freezing weather. In fact, February is our coldest month. I keep a greenhouse at our main property in Cedar Key to protect the plants. And I love being out there in the greenhouse growing vegetables and fruits and such. So I'm very aware of the cycles in the weather, but I'm also very conscious of temperature drops to make sure that we're protecting our plants and our food source. It's just something that I love to do. And when you're out there in nature, it just, you become one with your thoughts, and it's really relaxing. Now, I mentioned Cedar Key to you. That if you go on Google Earth, it's a beautiful little fishing village that is right on the Gulf of Mexico at the base of the Suwannee River Delta. And when the seasons change, and I'm looking out there in the water in the Gulf of Mexico, I often look at the tides because I like to fish as well. I'm an outdoors person. And for those of you that go fishing, the best times to go fish is when the tide is moving. It could be coming in or out, preferably in. So you got to know the tides. And when the tide is low and coming in, you have to also watch when high tide comes around. And in Cedar Key, when we have a full moon out, the tides become extraordinarily high. And in a lot of cases, we'll get flooding because it's right on the Gulf, and a lot of it's right at at the water level. So I do pay attention to this. So when we're looking at tides, when we're looking at the moon, when we're looking at gravitational pull, you could also throw in magnetic compass readings and how that changes in the axis of the Earth. I'm not going to get too scientific on you, but these are regular cycles. And you might think, well, what the heck does the moon and the gravitational attraction of the moon on the Earth have to do with trading? Well, this is why. Because this is actually a snapshot from my iPhone, and you can see all the way to the right here, that little blue dot, that's Cedar Key right there. And we were being threatened by Hurricane Michael a couple of years ago. And interestingly enough, this hurricane was hitting the Gulf of Mexico, and it hit us right here, this red band, during high tide. So what was happening is the tide was up, the storm was hitting, the storm surge was hitting as well. So it was all adding up, and we had incredible flooding right up into the capital of our state, Tallahassee. Now, again, hurricanes in Florida is something you have to pay attention to, maybe not all the way up there in Canada, but in the financial world, these weather patterns do affect prices. And I'm not talking about trying to, make money from the misfortune of others who are suffering in a hurricane or a storm like this. But when you're aware of the cycles, you can prepare. In hurricane season, let's face it, when I am looking at my calendar and I say, okay, hurricane season is about to come here, I go through a checklist. Okay, one of the first things that my wife and I have on our list is, hey, do we have the insurance premiums paid up to date? Yeah, absolutely. You got to make sure of that, right? Do we have gas in the generator? Have we run the generator? Have we cycled that? Are we stocked up with enough food? Is the well working? If we lose electricity, do we have enough water to survive if we lose power for a month or two or possibly more? These are things that we go through. Again, something that the Canadians may not be aware of, but these are regular patterns that we go through, checklists like this. Now, another thing that happens, and by the way, everything that I'm showing you relates to these cycles of hurricanes and gravitational pulls and such. But during the summer months especially, we have a thing called red tide. It happens in Florida and it happens in Texas, where there is this tide that carries itself with the currents of the Gulf of Mexico, and it's very damaging, not just to wildlife that presides on the shore and the coast and in the Gulf, but to the neighboring coastlines that are affected by this. And it's very, very damaging. Years ago, we didn't hear all that much about this microscopic algae. We didn't hear about this. It was maybe it was undiscovered. I don't know. Again, I'm not a scientist, but it wasn't something that we paid much attention to. But when the hurricanes started coming in, it increased the level of this red tide because the bacteria was thrown into different locations now because of the volatility in the weather. And boom, another cycle surfaced. Again, one that was very damaging as well. And the impact on our economies, both for Texas and for Florida, it was incredibly enormous, and it was damaging because the fisheries and the clamming industry that I'll talk about a little bit earlier. Now, again, in the light of the weather and what we're talking about, for those of you who had a chance to watch this movie, Trading Places, in 1983, Hollywood came to Wall Street, and it just so happened that I was on the trading floor at the time. And this particular movie, this is a reference as to where I pulled that. And you'll also see that my role in Trading Places was that more of a consultant than a trader on the screen. But what happened is they were trading orange juice. Now, the orange juice futures market, or the futures pit, was directly next to the silver option pit that I traded in. So all of us traders got together and we became part of the movie. Now the movie was based, the whole twist in the movie was how Eddie Murphy and Dan Aykroyd, aka the heroes, right? They got a hold of the actual weather report. They got a hold of the weather report because the weather was the news of the weather was going to shock the orange juice markets. Now think about this. In the movie, Eddie Murphy, again, for those who saw the movie, there was a scene where Don Amici and Ralph Bellamy, the two brothers, they sat Eddie Murphy down to give him an education on commodities. Now, this was my role in the movie. I went to John Landis. I said, the audience is not going to know what a commodity is. They're not going to know what short selling is. They're not going to know this, that. Well, they actually added this scene based on my recommendation where it looks as though Eddie Murphy is having breakfast in the office of these two brothers. And they take a couple of minutes and they explain what commodities are, right? Orange juice, pork bellies, wheat, coffee. I was a member of the Coffee Sugar Cocoa Exchange, so this was another part of my trading experience, and they explain commodities. Well, look at this picture for a second, folks. Every single one of these commodities can be affected or will be affected by an adverse weather report or an adverse weather condition, whether it be a hurricane, a drop in temperature, a freeze, a storm, flooding, drought, you name it. The cycles in the weather affect particularly these commodity prices. Now, for most of you, you're investors, right? Many of you are traders, and maybe a few of you trade the futures markets. Maybe a few, if that, even a few. But there are prices that are being driven and people trading the ebb and flow of price action due to weather. Now, harsh weather casualties I'm going to list. Again, I'm connecting the dots here so you can understand how, instead of being a victim of a harsh weather pattern or cycle, you can be a beneficiary of this. Knowing how to position yourself ahead of the storm, so to speak, is going to put a lot of money in your pocket if, big capital I on that if you know how to position yourself and if and when you know how to manage the risk on that particular trade. Okay? Very important, the risk. I'm going to overemphasize this because if you're on the side of a market that you think is in favor of this particular trend or cycle, and if it doesn't go as you expect it to go, you need to learn how to minimize the risk. It's really very simple. Now, looking at those who are the casualties now, right? Farmers. Well, I think we already discussed orange juice and orange growers. Well, any crop, whether it be sugarcane in Florida or peach trees in Georgia, if you have a hurricane and it affects their crop, the farmers are going to be affected and their yield will most definitely take a hit. They will not be able to produce as much of that particular crop. Therefore, damage done to those crops will cause prices to go up. All right, I'm just talking about the farmers now. Now, to the right here, this is an actual picture that I took of a sign that's literally right down the road from my house. This is Welcome to Cedar Key. Cedar Key produces the majority, 80% of the farm-raised clams that you find in the supermarket are from my little town in Cedar Key. It's amazing. They have, if you go out in the Gulf of Mexico, see the farmers off to the left here? The clam farmers actually have their little posts that line up in a line, and they have whole underwater fields of baby clams that they grow, and they go down this just like a farmer will harvest. With the harvester, they'll go out and take their fruit or vegetables or whatever they're farming. The clammers go out there and they farm their clams as well. Now in hurricane season, all those seed clams get damaged. and absolutely they're out of luck, you know. And tourism, you know, again, what happens? Tourism is affected because look what happened in Puerto Rico not too long ago from the hurricanes. A lot of those hotels are still suffering because they can't get the repairs done because there's not enough workers there to repair that. Insurance companies obviously take a hit, although I'm not going to feel so terrible for the insurance companies because they have actuaries that work for them that already pre-calculate what an insurance claim hit would be to their companies. So they make sure that they take in enough insurance premium to make up for the loss. However, when an insurance company takes a hit, insurance policyholders also take a hit because generally what happens are rates, especially with flood insurance, rates go up. So down the road, consumers and those who are insured take a hit as well. So they're all casualties. Now, who are the beneficiaries of harsh weather? Well, there you go. Top left. See the top left there? That is an, I don't know if you could see my cursor right here. See this house right here? That house is my mother and father-in-law's house right there. That is an actual picture from a drone that was taken by the National Guard that went in to assess the damage. That's their house right there. Home builders, fortunately, their house survived, but home builders are the beneficiaries because what happens is there's obviously huge demand that is created by those who are in the construction industry to come in and help with repairs. So home builders, that include lumber companies, anyone who caters to the home builders, those who manufacture generators. I don't know offhand brands or companies that manufacture generators, but again, if you're looking for ideas, okay, who are the biggest generator companies? Who are the biggest battery companies? Who are the biggest solar energy companies that would benefit? If you look for candidates, but if you're thinking of ideas, start to do your investigative research now so that when it comes time for you to look at the charts, you can see whether or not these companies have rallied during hurricane season. I'm going to give you some of the charts to look at so you can understand this more clearly. Hotels are beneficiaries because guess what? When people's homes off to the left are destroyed, they're driven to the hotels. They don't have a choice. And the home builders who live down there basically during the construction rebuild are pumping profits into the hotels. Bottled water companies, obviously. Building material companies, obviously. And the list goes on and on and on. Now, let's get into the theory. All right, I created the picture for you. Maybe it was entertaining, maybe it wasn't. We call that edutainment. But let's get into the theory. All right, cycles allow us to actually and accurately predict events in nature. Bird migration, count on it. The tides, you can count on it. Planetary movements, these are all things that are scientific in nature and you can count on them. They're regular cycles that you can rely on, but they're also, you have to look at how these cycles and the cycle analysis, what it means to how it would affect possible changes in the financial markets. Again, you have to look at the direct correlation in many cases and the inverse relationship as well. Like I said, when hurricane season hits and the winds are in an uptrend, guess what? Profits for insurance companies are going to be inversely related to those storms, right? So you have to keep that in mind as well. Now, this is, again, getting more into the picture of what it looks like. We have economic cycles, we have market cycles. Economic cycles are fairly predictable. We have boom economies, and then there's bust. We call those recessionary cycles. We have not had a recession in a long time, but that doesn't mean one is not on the horizon. I'm not going to go there and try to predict that. However, when economic cycles start to occur or change, we generally see the market change as well. And what happens is, if you study Dow theory in particular, Charles Dow in the early 1900s did not create this Dow theory to forecast the stock market. On the contrary, Charles Dow created his Dow 30 index to forecast the economic cycle. And we found to this day that the economic cycle and the market cycles are in perfect sync. They're just out of frequency just by a bit. And so what happens is the general markets lead the economy by about 9 months in general. So in other words, if everyone starts screaming recession, 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 but the stock market keeps going higher, 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 those people screaming recession are most likely going to be wrong, because in order for the recession to happen, we have to have the market start turning around, especially the leading economic stocks and companies that drive the economy. Hence the reason why the Dow 30 was created. These were the 30 most powerful companies that drove the US economy at that time. And to this day, the Dow 30 continues to evolve to represent those companies that are driving the economies. Hope you follow that, because this is a really important slide right here. And here's another, we have a lot of fun with this one every year. I'm not going to name the chocolate company, right? But the chocolate cycle, because every year, look at the next slide. See all these circles? That's when we start to buy in. And what happens is we then start to sell into February, or get aggressively protective in February. Why? Oh, why? Because of a date that's coming up pretty soon, February 14th, St. Valentine's Day. Guess what? People are still buying chocolate. They're buying chocolate into the holiday season coming up into Easter. But guess what happens? Because of the cycle pattern of people buying chocolate during the holiday season, that generally runs up profits during that time segment, and we can trade that. Again, we have fun with this, but if you go in and read it on the charts, you'll see. All right, so if you look, what do we do if this was the end of the year, right? Well, that's the big question mark. This is a dated chart, obviously, but we can look at actual charts towards the end of this presentation. Now, the predictable price cycles is actually something that we covered in the January effect. We did this towards the end of the year, again, perfectly timed. And we talked about the January effect. The January effect is a seasonal increase in stock prices. Here we are in January, right? And what happens is it generally follows at December, or it comes to the end of September. But what happens is there are traders and investors that are engaging in tax loss harvesting, and they're offsetting their capital gains from the previous year. So we generally get some selling. And then what happens is the money starts to move into small cap stocks. All right, you could blame this or give credit to this for year-end bonuses, to purchase more investments in the following month, whatever it may be. But it is definitely a cycle that cannot be ignored and shouldn't be ignored. Now, again, looking at the cycle in property and casualty, my circles, see the circles right there, the ovals rather, those are the times when we're in the hurricane season. You see this? And what happens is we see the property and casualty increase because the premiums are starting to affect the profits as well. Here are some more cycles that you want to pay attention to. Again, January effect, tax season, right? April 15th is tax day here in the US. And as a result of this, there's an old cycle saying that represents the cycle: sell in May, go away. Now, what does that mean? Well, actually, a lot of people do that. investors especially, sell and they go away. What do? What's the behavior pattern that follows that philosophy, sell and they go away? Well, they sell in May and they go away on vacation. And that leads you to the summer doldrums where we have less volatility and we have more, I guess you could say, stability in the summer months because there aren't as much trade activity during those months. And then what happens is we come into September, October, which are notorious for market corrections, and then we get into the year-end rally again. The cycle completes, aka the Santa Claus rally, which we did talk about in December, which in fact did occur like clockwork. The Santa Claus rally, we had that rally as expected and as we talked about it, not because anyone predicted it, but because it's a common cycle that many people react to. It's as simple as that. If there are recognizable cycles, people will trade and invest against them and in favor of them. Now, this is an actual picture of a tool that I used to use on the trade floor, because back in the day, before computers, I know I'm dating myself, but I was trading long before we had computers. I didn't have my first computer until mid 1985, where I had my IBM Model 50 that barely had 50 megs of hard drive on it. But we used to hand draw our charts, and we used this tool. It was like an accordion device called an Ehrlich cycle finder, and it would open up and we would connect each one of these little points. We'd start with the point here, we'd put it on the low, and then we would stretch out this accordion device and it would measure in equidistant measurements here the cycles, and we would expand and contract this device until we found the regular cycle. And then this end on the very end, so in other words, we started on the low here. When we expanded it, we would project out in time, so the last point on that cycle finder would be what we would project or forecast as the next low in the cycle. And it was extremely accurate. Again, we did this all by hand. This is what it would look like in today's technology. Each one of, you see these arcs right here? Imagine that the bottom or apex of this right here at the very bottom is a point on the Ehrlich cycle finder, okay? So you stretch it out until the next point gets to a low, stretch it out, and you kind of shift it with your eye to connect as many of these lows as possible. And you can see using the electronic cycle finder now that we have on our trading platforms, but you can see that this low came very, very close to what was projected out here. You see that? And so if it's starting to approach the next low in what we're projecting as a cycle, then maybe you should start thinking about accumulating new positions, or at least looking for signals on the charts that are more bullish, reacting to those bullish signals, and then, here we go, ready? Repetition, protect with sell stops or price alerts in the event this goes further than the low that we projected. So in other words, if we buy and it goes even lower, we have to do something to protect ourselves, because obviously that cycle didn't come to fruition, right? And there we go with the risk management part of what I just talked about. Now, here's how we do it by hand, or I should say, here's how we do it by eye, right? You have to scan the chart and more or less look for regular patterns. Like, let me give you this analogy. Imagine that you're in the medical industry and you're looking at a monitor known as an EKG, right? It's more or less an electrocardiograph, right? So you're basically measuring the heartbeat of your patient or the person that's sitting in the room. Okay. Now, a doctor could look at an EKG and hopefully that patient has a regular heartbeat, because obviously if it is irregular or there is no beat at all, that person's in pretty big trouble, obviously, right? But a doctor could look at an EKG and at a glance determine whether or not there's something wrong or whether or not everything is going very right. Now, when we're looking at patterns, kind of look back. Now, Chris, here's a better way to look at this one. Let's go to a weekly 3-year chart. Now, what I'm going to do, Chris, is I'm going to ask you to draw, if you can draw and keep these lines on the chart, that would be great. Can you draw vertical lines on the chart, vertical lines? Now, with your cursor, go to the low in April, right there. Now draw a vertical line from there straight up on the page, vertical. All right. Now, go to the next low in July. Right there, draw a vertical line. Now, there's another low in September, October, all the way to the right. It's a hammer pattern right there. Go straight up from there. All right. Now, there's already a line there, 2018. We're going to leave that in place. Now, what I want you to do is look at the lows that we have highlighted. Have you noticed that they are relatively equal in distance apart, or as far as equidistant? Does that look like there's a pattern forming there? There is certainly a pattern forming there. Now, if I go to 2018, and all I'm doing now is going out as far as the previous line was, I'm going to go to the right now and draw another vertical line and keep going. Right there, Chris, right at the bottom of April. Go straight up. Go to the end of June, or I'm sorry, the beginning of June, right there, go up. Or you can even go down if you could see the line better. Now, look, this stock has a regular cycle. Now, if we had a cycle finder, it would be so much easier to see it. But even if you don't have a cycle finder, what am I asking you to do? I'm asking for you to look for the cycle. Now, when you're measuring cycles, you generally go from low to low to low to low. And believe me, it's not always going to fall exactly on that cycle period, but for the most part, it will. So I'm going to leave it with that. I really enjoyed this presentation. I hope you did too. I'm going to hand it back to Chris, and I hope to see you on the next webinar. Thanks, folks.
Awesome, AJ. Thanks so much, and we always appreciate it, as always. And then with that, I want to thank you for your time and good luck with trading.